A term that is periodically buzzing around in society is the recession. When the word is heard frequently, families do not splurge their savings, neighbors start losing jobs, and your favorite shop unexpectedly does not serve your favorite pizza anymore because they've downsized. If you go by its textbook definition, a recession is a temporary economic decline in which trade and industrial activities reduce. It is identified by the fall in GDP in 2 successive quarters. But there's more to it. Various factors, such as a drop in consumer confidence, rising interest rates, a stock market crash, and the bust of asset bubbles, can bring on economic recessions. When left uncontrolled, most circumstances that drive the economy to sluggish can also trigger a recession. Although a fall in GDP growth is frequently cited as a cause of a recession, it is more of an indicator that one is already underway. Since the GDP is only released after a quarter has ended, the recession has likely already started by the time the GDP turned negative. Generally speaking, recessions are characterized by 2 or more consecutive quarters of declining GDP. That guideline is not followed by the National Bureau of Economic Research (NBER), frequently used to date recessions. Deepness, diffusion, and duration are the 3 different criteria that NBER employs. Before we delve into the details of what causes a recession, make sure you hit the like button. Please share the video to educate others and subscribe to our channel. With that, let's go. Number 8. Loss of consumer confidence. Consumers stop buying when they lose faith in the economy, which can create a vicious cycle. The necessity for or ability to afford to hire new workers will gradually decline unless the demand for goods and services is sufficiently high. As a result, the economy will create fewer jobs. Sales will continue to decline, and producers will generally reduce output in response to the declining demand. Reducing output also entails reducing employment, raising the unemployment rate, and prompting people to reduce spending. Number 7. High interest rates. Increased borrowing costs due to higher interest rates deter consumers and businesses from taking out loans to finance purchases or investments. The economy's demand for products and services declines because of lower spending. As a result of the decline in demand and the subsequent production reductions, firms hire fewer employees. Inflation declines as economic spending declines. However, a recession may occur if rising interest rates push the economy into an unsustainable state of contraction. Number 6. Stock market crash. A recession might result from a stock market meltdown. Investors frequently need more money to invest in enterprises as stock prices fall. Layoffs or hiring freezes may result if businesses need to raise funds for expansion and running expenses. Some of the most significant stock market crashes in American history occurred right before a downturn in the economy. These include the Black Tuesday stock market crash of 1929, the financial crisis of 2008, and the COVID-19 related short-term slump. Number 5. Deregulation. When they eliminate crucial safeguards, legislators risk starting a recession. When the Garn-St. Germain Depository Institutions Act was passed in 1982, the roots of the savings and loan crisis and the ensuing recession were sown. The loan-to-value ratio and interest rate ceiling restrictions for savings and loan associations were eliminated by this law, and the Depository Institutions Deregulation and Monetary Control Act of 1980. The 1990 recession was brought on by the savings and loan crisis. Due to property flips, dubious lending, and illegal activity, more than 1,000 banks with $500 billion in assets failed. Number 4. Post-war recessions. In American history, post-war recessions have occurred regularly. After World War II, the Korean War, the Vietnam, and the Gulf War, there were recessions. Following the Korean, Vietnam, and Gulf Wars, there was a 4.5% decline in annual growth and an increase of 1% in average unemployment. Number 3. Credit crunches. A credit crunch happens when there's an unexpected decrease in the amount of money that may be borrowed, which reduces the number of loans. For instance, during the 2008 financial crisis, banks suffered significant losses as a result of the high number of defaulted mortgages and the faulty mortgage debt they had purchased. They were extremely hesitant to make loans as a result of these losses. Interest rates rise, and less money is available for businesses and individuals when lenders are more cautious. That might cause a recession. Number 2. When asset bubbles burst. Asset bubbles develop when the cost of investments such as gold, equities, or real estate go beyond reasonable. When a bubble pops, it already creates the conditions for a recession to take place. The housing bubble and the dot-com stock bubble occurred just before the recessions of 2001 and 2008, respectively. Deflation. Deflation lowers the market value of the goods and services offered, motivating consumers to hold off on purchases until costs are lower. Since they cannot afford to take on debt at such high interest rates, it is frequently linked to high interest rates, which may also make consumers wait to make purchases. Because businesses must reduce expenses, deflation can also result in a rise in unemployment. Since unemployed people frequently cannot spend money to stimulate the economy, this may produce a deflationary cycle. When will a recession hit us next? Or has it already? Your opinions are welcome. Let us know some ways of battling a recession in the comments below, and become a helpful member of our audience community. See you in the next one. Till then, stay curious.